There is a hidden housing crash happening right now as you watch this video. While many seem to be ignoring the obvious, the real estate market has entered into crisis mode, and what awaits us in 2023 is a disaster that could be worse than what we saw in 2008. While many remain skeptical due to some conflicting reports, fresh new data is pointing to a troubling future. Many crash skeptics argue that nationwide home prices aren't showing any clear decrease, and they're somewhat right from a technical standpoint. The widely used Case-Shiller Index measures home prices in the United States, and as of the latest reading in September 2022, prices have only dropped a small 2.5% from their peak in June. So, some people like to say that homes are just cooling off, ruling out the possibility of a crash, especially since we're still 38% higher than pre-pandemic levels. However, this perspective doesn't fully capture the current situation. The Case-Shiller Index is known for being a lagging indicator, meaning it reflects changes after they've occurred. To put it simply, when you dive into the technical details of how the Case-Shiller Index is calculated, you find that it uses an average number that looks back almost 3 months. This setup implies that even if home prices are actually dropping rapidly, the Case-Shiller Index might not show it as dramatic, especially in the early stages of a downturn. This isn't just our opinion. We can prove this by looking at Redfin numbers. Redfin is like a big website that shows houses for sale. They have lots of information about houses. Their numbers are not only right, but they're also fast. Redfin can see houses for sale right now and figure out averages without waiting for official records. Other websites like Zillow and companies that use technology for property, we call them PropTech, often take longer to update their prices because they wait for official records from the government. The Case-Shiller is a good way to know about the housing market, but it sometimes takes a while to show what's happening right now. So the big question is, what do these numbers say? Like I said before, the Case-Shiller showed the highest prices in June of 2022, but Redfin's numbers showed the highest prices in May, 1 month before the Case-Shiller. This might not seem important, but if we look deeper, we can see a big difference that's making a lot of investors worry. If we check the Case-Shiller, it says prices went down by 2.5% from the top to the bottom. That's not much. But if we look at Redfin, it says prices already went down by 12.6%. That's a big difference in the world of houses. Usually, prices don't change much over a year, so seeing a big drop in just a few months is a big sign that something might be wrong with the housing market. As the day comes to an end, the Case-Shiller Index seems to be lagging behind the rapid pace of this ongoing economic downturn. The reality is right there in front of us. The crash is happening, and it's not just financial YouTubers sounding the alarm. Even influential CEOs in the industry are expressing concerns. Lance Lambert, a representative of Fortune magazine, recently had a conversation with CoStar CEO Andy Florance. CoStar is widely recognized as a global leader in commercial real estate analytics and information. Florance was unequivocal about his outlook on the market, stating, "People who believe a mere 10% drop in home prices is on the horizon are living in a dream. A more realistic estimate would be a 20% decline." This sentiment is echoed by various institutions. KPMG, a respected accounting firm, recently projected a 20% decline in the Case-Shiller Index by the fourth quarter of 2023. It's essential to note that this is a national average, and the impact will be even more severe in markets that were artificially inflated. Take Boise, Idaho, for instance, which experienced one of the most significant post-pandemic housing market surges. Prices there have already plummeted by over 20%, surpassing the national average drop of 13%. This indicates a distressing reality for many American cities that find themselves in similarly inflated situations. If housing prices across the country have dropped by 13%, as per the most reliable data we've got, and in certain active markets, they've fallen over 20%, where are we headed from here? According to many folks, things might turn out worse than what went down in 2008. When experts chat about a crash like this, the main thing they focus on is the cause. Back in 2008, the housing market went haywire because of dodgy loans. You might have seen this in the movie The Big Short. What really went on was that getting loans became way too easy. Lots of folks became homeowners, but it wasn't all good news. Too many people were buying houses with money they didn't really have. They were taking on debts that their income couldn't cover. On top of that, there were these new kinds of loans with low initial rates that made people think they could afford them. But in reality, it was just an illusion. Today, loans work very differently than before. The rules and standards have gotten better, and the risky subprime market isn't really around anymore. So if everything seems strong and healthy, what could make things go wrong? The big reason, which isn't talked about much, is when investors pull out their money. For the past decade, major investors from Wall Street have changed the way people buy single-family homes. Companies like Opendoor, Redfin, Zillow, and many others joined in and started buying properties. They called these programs iBuyer, where they'd give you an instant offer for your house and buy it with cash. This shook up the market because these offers were often really good. Sometimes, these companies offered way more money than what most people thought was a fair price. These were huge tech companies that weren't making profits a priority, but rather wanted to grow as much as possible. These big players were competing fiercely for a bigger share of the market. They were ready to buy lots of houses, even if they didn't make much profit on each one. This changed how things worked in many cities. This whole thing made prices shoot up a lot. These companies called iBuyers were buying tons of houses and then selling them again for crazy high prices. That pumped up the costs of houses in whole areas. It went on for a long time, especially after the pandemic when things were wild. The interest rates were super low, and everyone was feeling really excited, which made prices go up faster than ever before. These companies weren't the only ones. They made it look like a good deal, so regular people, like smaller investors and folks who buy and fix up houses quickly to sell them for more money, jumped in too. They thought, buy a house, fix it up, wait a bit, then sell it for a lot more. But doing this made prices go up even more. So, what we got left with is this. Lots of the people buying houses were investors. A report from Redfin said that in the last part of 2021, almost 1 out of every 5 houses sold in the US was bought by an investor. And in some places, like Vegas, nearly 30% of houses sold went to investors. This is just what they saw officially. If we count the houses sold without going through the usual channels, the percentage would be even higher. If we only look at houses sold in normal areas, that number would probably be even crazier. Last year, investors pretty much took control of the market, and now everything is falling apart. The main reason for this collapse won't be bad loans. It's going to be the complete breakdown of iBuyers. Redfin has already sold off most of its single-family properties, and other companies are on the brink of bankruptcy. It's just a matter of time before all the investors leave the market. Back in 2008, subprime mortgages only made up 13% of all mortgages. Even though it sounds small, 13%, when mixed with everyone else who had a mortgage or paid theirs off, caused the entire market to crash. Now, we have a situation where nearly 15 to 20% of all homes are owned by investors. Imagine what will happen when they all decide to sell at the same time. The same forces that made prices shoot up will now make them drop, especially with higher interest rates and a slower economy. When we look at a company like Opendoor, which lost a massive $928 million in just the third quarter of the year, it raises concerns about where things are headed. Many people say the company might go bankrupt, and there are clear reasons why. Kevin Magna's post shows a big problem. In places around San Francisco, Opendoor can't sell the homes it has for sale. For example, they put a house up for $2.2 million, and now, almost 6 months later, it's still on the market, and they've cut the price by almost $500,000. This is just one house. If you imagine this happening with thousands of other homes, you start to see why people are worried about how long Opendoor can keep going and how it might affect the whole industry if they have to sell off everything. No matter what happens, 2023 promises to be a fascinating year. iBuyers and investors are leaving the real estate market because prices are falling so much. Thanks for watching, everyone! If you enjoyed the video, please remember to hit the like and subscribe buttons, and feel free to drop a comment below. Your support means a lot.